Welcome to the week that was, where we take a deep dive into the most important developments shaping the financial landscape. This week, wow, we're unraveling a truly dynamic period for Bitcoin and the broader digital asset market.
Yeah, it really was.
It's been a fascinating interplay of, macroeconomic shifts, crucial regulatory clarity, and some really compelling institutional moves.
Definitely.
Our mission today is to unpack how these forces converge to shape the market, what it means for its future, and, importantly, what key insights you can draw from these shifts.
Indeed. We've watched Bitcoin navigate a pretty complex environment, moving from a period of sort of cautious consolidation to a really significant breakout. And understanding these shifts isn't just about, following prices day to day.
No.
It's about recognizing the underlying structural changes that are reshaping the entire financial ecosystem.
Okay, so let's start at the beginning of the week. Bitcoin was in that clear consolidation phase, hovering around, 110,000 to 112,000?
That's right, around that mark.
Analysts were describing the market as fragile. But interestingly, with these underlying constructive signs, what was creating that delicate balance, that sense of like a market holding its breath?
Well, beneath the surface, it was a real tug of war, actually. On one hand, you saw significant sell-offs from very large entities, whales, as they're often called, distributing around 115,000 Bitcoin. That's, over $12 billion?
Wow, yeah.
A clear signal of intense risk aversion. But then on the other side, you had other investors actively buying the dip.
Right, stepping in.
Exactly, stepping in within that $108,000 to $116,000 range, effectively absorbing that supply. It prevented a larger downturn, and it created this kind of air gap in the market, a void quickly filled by new demand. And this period, it really tested the short-term holders, too. Their profitability just collapsed, went from over 90% down to like 42%.
Ouch.
Yeah, before quickly rebounding. So it highlighted some stress, definitely, but also remarkable resilience. Technically, we were stuck in a decision zone, just waiting for a clear catalyst.
And those catalysts were very much on the horizon, weren't they? You had the looming U.S. inflation data.
Yep.
Specifically, the Producer Price Index, PPI, and the Consumer Price Index, CPI.
Typical numbers.
And, of course, the Federal Open Market Committee, the FOMC meeting. Big stuff.
Absolutely. The market was intensely focused on these macroeconomic inputs. Why? Because they were expected to dictate the Federal Reserve's monetary policy.
Right. The rigged decision.
Exactly. And historically, looser monetary policy, lower rates, tends to be supportive of risk assets like Bitcoin.
Sure.
The big question then was, was a potential rate cut already priced in by the market? Or was there still room for a significant reaction?
Right, the classic buy the rumor, sell the news possibility too.
Precisely.
But despite all this macro uncertainty, we also saw this continued push from institutional and corporate players. It felt like two different narratives playing out at the same time.
That's a great way to put it. You had companies like Strategy, formerly MicroStrategy, of course, continuing their accumulation strategy. Added another, 1,955 Bitcoin.
Just keep stacking.
They just keep stacking. And the Tokyo-listed firm, Metaplanet, they also announced really ambitious plans, 100,000 Bitcoin by 2026.
Wow.
And this isn't just about financial exposure anymore. It signals the emergence of this new asset class, Bitcoin treasury companies.
Interesting term.
Yeah, where Bitcoin accumulation is actually a core business strategy, not just some side investment.
Okay.
We also saw the European digital asset firm CoinShares preparing for a huge $1.2 billion NASDAQ listing. That signals growing mainstream access.
Yeah, that's significant.
And even El Salvador, marking its Bitcoin law anniversary, added another 21 Bitcoin. It just reinforces this idea of Bitcoin as a potential national reserve asset for some countries.
And on the regulatory front, even early in the week, there were these signals of change, leaning towards maybe a more accommodating environment.
They certainly seem that way. The U.S. Congress was actively seeking a detailed report from the Treasury Department about creating a national Bitcoin reserve.
Right. Building on that earlier executive order.
Exactly, to retain seized digital assets. This move, it suggests a durable, maybe even bipartisan effort to legitimize and integrate digital assets. And NASDAQ filed a formal proposal with the SEC to allow trading of tokenized securities on its main exchange. That's a huge step towards bridging TradFi and blockchain.
A head-wreck bridge, yeah.
And Robinhood Markets, a major player in the retail crypto space, got included in the S&P 500.
Right, I saw it.
And their crypto trading business was cited as a key factor in that recognition. That's mainstream validation.
Okay, so moving into the middle of the week now. Bitcoin was definitely seeing heightened activity, price around $112,500.
Yeah.
It really felt like the market was approaching a pivot point, didn't it? Ready for a decisive move.
It absolutely was. Trading volume had surged up to around $40.8 billion. That's a clear sign of increased engagement, people taking positions.
Right.
Technically, Bitcoin was testing a critical resistance zone, but importantly, a strong support cluster had formed below that, reinforced by several converging exponential moving averages. Those are basically, lines showing average prices. When they converge like that,
Suggests solid demand.
it exactly suggests solid underlying demand. And even more encouraging, the MACD indicator, the moving average divergence, was showing this gradual bullish crossover, signaling that upward momentum was kind of steadily building beneath the surface.
Interesting. Now, beyond the price charts, you mentioned this concept of a great redistribution in Bitcoin's ownership structure.
Yeah.
What exactly does that mean, and why is it so significant?
Right. This is truly fascinating, and it's a pretty major structural shift we're seeing. On-chain analysis, looking at the blockchain data itself, showed a rapid decline in addresses holding over 1,000 Bitcoin. Those are your traditional whales.
Okay, they were decreasing.
They were decreasing. But simultaneously, addresses holding between 100 and 1,000 Bitcoin, what we might call medium players, they significantly increased. Well, this shift isn't just random. It's directly tied to the rising influence of institutional investment vehicles, particularly those spot Bitcoin ETFs.
Ah, the ETFs.
Exactly. Assets bought by managers like BlackRock or Fidelity for their ETFs, they're held in these large regulated custody wallets. And on-chain, these look like medium player addresses.
I see. So it's institutions distributing ownership in a sense.
In a sense, yes. But the key insight is that this structural transformation, it actually mitigates concentration risk. It makes the market more resilient, more liquid.
Which is attractive to...
Which is incredibly attractive to conservative institutions like pension funds. It makes the whole asset class look less risky from their perspective.
Got it. And this corporate treasury adoption, the idea of companies holding Bitcoin on their balance sheets, that just kept accelerating too.
Yeah, absolutely. Strategy added another $217 million worth of Bitcoin, solidifying its position as the largest corporate holder, and, interestingly, a prominent candidate now for S&P 500 inclusion maybe in December.
That would be something.
Wouldn't it? And even more striking, this marketing firm, Asset Entities, surged over 50% after a merger. They formed Strive, Inc., with the explicit goal of raising $1.5 billion solely to acquire Bitcoin for its corporate treasury.
Just for Bitcoin.
Just for Bitcoin. That demonstrates this profound evolution where holding Bitcoin is becoming like a viable standalone business model for some.
Wow.
We also saw continued political momentum, the current U.S. administration enacting some crypto-friendly policies, and even the Trump family's business ventures signaling strong commitment. All this helps reduce perceived regulatory risk for corporations thinking about it.
Globally, though, the regulatory picture was still a bit patchy, wasn't it?
Yeah.
Some moving forward, others more hesitant.
It was, yeah, a mixed bag is a good way to put it. In the U.S., you had the SEC and CFTC increasing collaboration, trying to modernize rules, achieve harmony. That's generally seen as positive. Contrast that with Vietnam, which approved a 5-year pilot program for regulated crypto trading. They're positioning themselves as a potential hub. But then you had India leaning against a comprehensive legislative framework, citing fears of systemic risks. So this divergence, it's definitely going to impact where capital and talent decide to flow in the coming years.
Yeah, absolutely. We also saw the ecosystem of crypto financial products rapidly expanding, moving beyond just Bitcoin. That hints at a broader trend, right?
Right. It's not just about Bitcoin anymore, though it leads the way. Following the Bitcoin ETF success, Grayscale filed to convert its Litecoin, Hedera, and Bitcoin Cash trusts into spot ETFs, too.
Spreading the model.
Spreading the model. And a really significant development, maybe, was the anticipated launch of the first spot Dogecoin ETF by REX shares.
Dogecoin, really?
Really.
Yeah.
Signaling what some are calling the financialization of internet culture. It's quite something. Furthermore, Cboe Global Markets announced plans for 10-year dated futures contracts for Bitcoin and Ethereum. That provides crucial tools for institutions with long-duration liabilities, like insurers or pension funds.
Okay, longer-term instruments.
Exactly. And NASDAQ, as we mentioned, was reportedly working with regulators to launch a platform for tokenized securities. That indicates a shift towards leveraging blockchain for existing financial systems, not just creating new ones.
Okay, so then midweek, the market experienced that truly decisive shift. What happened? What allowed Bitcoin to just shatter that consolidation range and surge past the significant $114,000 resistance? Analysts called it a decisive shift.
Yeah, it really was. And it was primarily driven by this powerful convergence of factors, most notably softer than expected U.S. inflation data.
The PPI number.
The PPI number first, yeah. The producer price index for August actually fell by 0.1%. That surprised economists.
Okay.
And that immediately led markets to price in like a 93% probability of a 25 basis point interest rate cut at the Fed's upcoming meeting.
Huge jump in probability.
Huge jump. This dovish shift, combined with those earlier downward revisions to U.S. job growth figures we saw, it just created this compelling narrative for monetary easing. And Bitcoin, as a risk asset, reacted swiftly. It sensed a more favorable economic tide.
Okay.
We also saw the CPI, the Consumer Price Index, data come out that morning, projected a 2.9% year-over-year increase for August, largely in line with expectations, which actually helped by removing some uncertainty.
So the surprise was the PPI drop, and the CPI just confirmed things weren't getting worse.
Exactly. It took some fear off the table.
And the technical indicators, the charts, I heard they were absolutely screaming bullish at that point.
Oh, absolutely. We saw a MACD golden cross on Bitcoin's chart, the first one since April.
Explain the golden cross again.
Right. So a golden cross is when a shorter-term moving average crosses above a longer-term moving average. It's often seen as a signal of a potentially significant upward trend starting.
Okay.
And historically, the last time this happened, back in April, it preceded a gain of over 40% in Bitcoin's price in the following month. Now, past performance isn't indicative of future results, of course, but some analysts were already projecting potential price targets like $160,000 for October based on that signal.
Wow.
And concurrently, the Bollinger Bands, which measure market volatility, they reached their most extreme level of compression.
Meaning?
Think of it like a coiled spring, super tight, usually signals an explosive price expansion is imminent, either up or down, but usually follows the prevailing trend.
Got it. A lot of pent-up energy.
Exactly.
Now, this period also brought what you described earlier as landmark regulatory clarity in the U.S., a paradigm shift. What was so fundamental about these developments?
Yeah, this was really significant. You had Jonathan Gould, head of the OCC, the Office of the Controller of the Currency,
Right.
unequivocally state that crypto-related activities banks want to pursue are legally permissible. And he explicitly condemned debanking, banks refusing service to crypto firms.
That's a strong statement from a regulator.
Very strong. And separately, SEC Chair Paul Atkins stated that, in his view, most tokens are not securities, and supported the idea of super app platforms for unified digital asset trading.
Okay, that's different from some previous SEC stances.
Quite different. These statements, building on that earlier SEC and CFTC joint statement about harmonizing regulation and the Fed withdrawing restrictive crypto guidance, it really represents a strategic pivot by the U.S.
From adversarial,
or at least uncertain, to one of actively fostering domestic innovation. It's essentially like a regulatory invitation for institutions to come in with more confidence.
Okay, that makes sense. And meanwhile, that unseen tide of institutional capital just kept flowing in, accumulating.
Indeed. Corporate digital asset treasuries now hold over $113 billion in Bitcoin. That's across more than 90 publicly traded companies.
$113 billion.
It's a huge number. Pop Culture Group, for example, announced a $33 million strategic investment just to acquire 300 Bitcoin. They see it as an inflation hedge and a growth catalyst. This represents a really significant long-term pool of structurally held demand. It's not just traders anymore. And we're also seeing major players treat the Bitcoin ETFs with real rigor now.
How so?
They're actively rotating capital from higher fee ETF options to lower fee alternatives, just like they would with a traditional S&P 500 ETF. It shows they're serious, they're managing costs, it's maturing institutional engagement.
That's a good sign of maturity, yeah. And the underlying network itself, Bitcoin's core infrastructure, how did it hold up?
Crucially, it remained incredibly robust. Bitcoin's network health and security hit new all-time highs. The hash rate, that measure of security and computational power, was at 1.129 billion terahashes per sector. That's a staggering 75% increase year over year.
Wow.
Mining difficulty also adjusted upwards to new all-time highs. This continuous growth, it signals immense investment and extreme confidence from miners.
And the miners were holding.
Right. They were strategically accumulating instead of selling heavily, creating this powerful supply squeeze dynamic. This foundational strength, It often gets overlooked in the day-to-day price action, but it's a critical long-term bullish signal.
Okay, so let's get to the end of the week. Bitcoin's rally had really solidified by then, surging past that psychological $115,000 level, hit a 3-week high, briefly touched, around $116,900?
That's right, yeah. It truly marked the end of that earlier consolidation, a definitive break higher.
And volume supported it.
Absolutely. The rally was accompanied by another surge in daily trading volume up to $52 billion, reinforcing the strength of the move.
So what are the key technical levels to watch now?
Well, resistance is right around that recent high, $116,900. If it breaks convincingly above that, potential targets extend up towards the $118,000, $120,000 zone.
Okay, and support?
A new support base seems to have formed between roughly $113,700 and $115,000. And interestingly, that strong upward move triggered a significant short squeeze.
Oh, the shorts got caught.
They did. Forced over $101 million in liquidations. Caught many traders who were betting against the price completely off guard.
What about the on-chain data during this latest part of the rally? Did it tell us anything revealing about holder behavior?
Yeah, the on-chain data offered some fascinating insights, actually showed signs of market maturity. We continued to observe long-term holders persistently accumulating. They added around 218,000 Bitcoin since March. Strong underlying demand, real conviction there.
Okay, the hodlers are O2 dealing.
Exactly. But at the same time, newer whale wallets, those holding 1,000 to 10,000 Bitcoin, they actually realized about $3.2 billion in profit since April.
So some profit-taking from newer large players.
Yes, and this divergence is actually quite healthy, surprisingly.
How so?
While the long-term holders provide that solid demand floor, that base of support, while the newer, maybe faster-moving large players taking profits at resistance levels, it allows for natural consolidation. It prevents the market from just going parabolic and potentially crashing harder later. It allows for a more sustainable climb.
Okay, that makes sense. A healthy market breathes.
Precisely.
And when we look at capital flows across the digital asset space, did we see a distinct institutional preference during this rally?
Yes, very clearly. Money was decisively rotating into Bitcoin, reinforcing its role as the primary digital asset, the reserve asset of the space.
The ETFs again?
The U.S. spot Bitcoin ETFs saw staggering net inflows, over $1.57 billion just over the last 3 days of the week, including $642 million on Friday alone. That completely reversed August's outflows.
Wow, big reversal.
Huge reversal, a real flight to quality within digital assets. And that kept Bitcoin's market dominance firm, around 57%.
But what about altcoins? Did they get left behind?
Not entirely. We also saw the altcoin season index rising, hit 67, up from a low of 29 last month.
Okay, what does that suggest?
It often suggests that as Bitcoin leads a rally and starts to consolidate, perhaps, capital begins to cascade down. First, into larger cap altcoins like Ethereum, and we saw that. Ethereum ETFs broke their multi-day streak of outflows, logged 3 straight days of inflows, including $113 million.
Okay.
And this movement, if the overall rally is sustained, typically precedes a flow into smaller, maybe riskier altcoins later on.
Interesting. So the macroeconomic engine, it just kept providing that foundational momentum through the end of the week.
Indeed it did. That U.S. CPI data for August, showing the 2.9% annual inflation rate, perfectly in line with expectations, that was profoundly bullish in its own way.
Because it wasn't a negative surprise.
Exactly. It removed a key piece of uncertainty. It validated the disinflation narrative. It basically gave the market a green light to continue focusing on the potential rate cuts.
Right.
And this, combined with that recent U.S. jobs report showing significant labor market weakness, remember the downward revision of 911,000 jobs, unemployment rising to 4.3%.
Yeah, weak numbers.
Weak numbers solidified expectations for a Federal Reserve rate cut at the upcoming September 17th FOMC meeting. Prediction markets were showing nearly a 100% probability of a 25 basis point cut.
Wow, almost certain.
Almost certain in the market's view. And that led to a softening U.S. dollar, which is typically a direct tailwind for Bitcoin.
Okay. And there was more institutional conviction signaled by something interesting on-chain, a very old wallet.
Yeah, this is a fascinating little moment for market historians, really. A dormant Bitcoin wallet, created nearly 13 years ago.
Wow, ancient.
Ancient in Bitcoin terms. Moved approximately 445 Bitcoin, worth over $50 million for the very first time.
Huh. Any idea why?
No clear reason, but this Satoshi-era whale movement, it just offers this rare, tangible link back to Bitcoin's earliest days,
Yeah.
a glimpse into those foundations.
Cool.
And simultaneously, you had BlackRock, the world's largest asset manager, reportedly exploring the tokenization of its own ETF product.
As ETFs.
Yeah. And NASDAQ actively building that market structure for tokenized securities, submitting rule changes to the SEC. These are concrete steps by TradFi titans. It indicates this idea of the tokenization of everything is really starting to transition from just theory into reality.
Big moves happening under the surface. And the U.S. regulatory picture continued to clarify towards a more sort of structured approach.
Yes, another potentially pivotal shift was signaled by SEC Chair Paul Atkins. Speaking at an OECD event, he supported a more tailored approach to crypto regulation under a new framework they're calling Project Crypto.
Project Crypto.
Yeah. He actually criticized the regulator's history of aggressive enforcement and proposed a unified licensing system for crypto firms. It suggests a real move towards collaboration and clarity rather than just constant conflict.
That would be welcomed by the industry, I imagine.
Immensely. And globally, the Crypto Asset Reporting Framework, CRRF, developed by the OECD.
Right, for tax harmonization.
Exactly. It saw rapid adoption. Over 60 nations have now committed to implementing it by 2027. That's huge for global compliance and standardization.
Okay, so lots of bullish momentum, macro tailwinds, regulatory clarity, institutional adoption. But despite all that, the derivatives market was sounding a note of caution, added a layer of complexity.
It was, yeah, and it really highlights sophisticated market behavior these days. Open interest in Bitcoin futures and perpetual swaps remained elevated, near all-time highs.
Which means?
Well, while it shows strong conviction from some, it also signifies high leverage in the system. And high leverage makes the market susceptible to cascading liquidations if the price moves sharply and unexpectedly against those positions.
Right, increased volatility risk.
Exactly. And the options market showed a put-call ratio of 1.3.
Meaning more puts than calls.
Right. More bearish bets, puts, than bullish bets, calls. This suggests sophisticated traders were likely hedging their long spot positions.
Protecting their gains.
Protecting gains, or perhaps speculating on a short-term drop, especially with that potential sell the news risk around the Fed's rate decision next week. Even if they cut, was it already priced in?
Right.
So this divergence between the positive spot activity, the ETF flows, and the more cautious derivatives positioning, it implies a sophisticated strategy by many players. Long-term accumulation may be hedged by some short-term trading or protection buying.
Fascinating. Okay, so to sort of synthesize this incredible week, Bitcoin has decisively transitioned from that consolidation phase to what we could describe as maybe volatile appreciation.
Yeah, I think that's fair. Volatile appreciation. It's been propelled by really powerful macroeconomic tailwinds, those impending Fed rate cuts.
Yeah.
A massive surge in institutional demand via the spot ETFs. Key driver, and unprecedented network security underpinning everything. These factors, they really form a strong fundamental and structural foundation.
It certainly paints a picture of a market evolving incredibly rapidly. The distinctions between, crypto markets and traditional markets are just blurring more and more.
They really are.
And that fundamentally changes how you, the listener, need to approach understanding and engaging with global finance now.
Absolutely. The long-term investment thesis for Bitcoin, you could argue, has been significantly strengthened by these developments.
Yeah.
But the ascent to new all-time highs, if it comes, will likely be contested. It'll probably be marked by sharp two-way volatility. We saw that caution in the derivatives market.
Right.
And the period right around the September 17th FOMC meeting will be particularly critical for near-term directional clarity. Lots of eyes on that.
It's a compelling future to watch unfold, isn't it? With traditional finance embracing digital assets in these new and sometimes unexpected ways, what stands out most to you from this week's deep dive? And maybe more importantly, how will you navigate this increasingly integrated financial landscape?
Lots to think about.
Definitely. Until next time, stay well informed.